Good morning, everybody. Thank you so much for joining us on today's session. My name is Bonolo Modise, and I'm from the Global Markets Retail team. On the line, I do have Palisa Moyaba from my team as well. And then I've got our esteemed guest, Simon Brown. If you haven't seen his face, that means you haven't registered for our Power Hour or you haven't been listening to the podcasts or other various webinars we do lots of amazing stuff with Simon Brown, and he provides a lot of education around investing and trading on our platforms. So, before I kick off for today's session, I'd like to notify you or let you know that this presentation is being recorded. You can ask questions on the Q&A tab. Alternatively, leave your comments on the chat tab. So, without any further ado, I'd like to hand over to Simon Brown, who will be talking about tax free investing on Shyft. You probably might have opened a tax free investment account on your SGB mobile app or your banking app, but we are also pleased to announce that you can now open your tax free investment account on Shyft. But Simon will talk more about it, and he'll also give us a bit of insights about how you can possibly build long term wealth with your tax free investment account now on Shyft. If you don't already have Shyft, you can download Shyft on www.shyft.co.za. There's a QR code right at the bottom of the website. Alternatively, you can access it on your Apple Store or Google Play Store. So, without any further time, Simon, over to you. Welcome and thank you for joining us again this morning. We look forward to today's presentation. I can't wait. I know all your presentations are full of good insights. We often leave the webinars feeling like, sheesh, how did I not think about that? Or how does he know all of that? So I'm pretty excited. We're very excited actually to hear more about this. Welcome over to you.
Manolo, thank you very, very much, ladies and gents. Good morning. Welcome. As Manolo said, my name is Simon Brown. You'll find me all over the interwebs, I suppose, is the best way to say it. And today we're going to be talking tax-free investing, specifically on Shyft. And then we've got a follow-up in 2 weeks' time where we're going to look at millionaire tax-free portfolios. How do we build to that first million? And then we've also got a power hour shortly thereafter as well, where we're looking at ETFs. All of that will come. We'll have links at the end. As Bonolo said, we are recording as well. But the focus today is going to be on those tax-free investment accounts. And what is a tax-free investment account, particularly how it works on the Shyft platform. That is very important. Tax benefits. And why they really do matter for long-term investing. The short-term benefit might not seem like much, but over the long term, the numbers absolutely stack up. Annual and lifetime limits, those are hugely important. There are some other rules that we need to know. And how to use the tax-free investment account as part of a long-term wealth plan. It's not as on its own. There are other components that we need to look at as well, and we will certainly cover that in this presentation in the same time. But a quick point on, what is it? It is really literally a legal way to remove paying tax. To be clear, every February, our finance minister stands up and talks about taxes and what they're increasing and etc. And it's invariably increases of taxes. And yes, we can structure our personal affairs to be tax efficient, but a tax-free account is literally a legal way to not pay any tax on investments that sit within the tax-free account. And that is a very important point. You can't just sort of point at a random account and say, I designate that. You've got to be with a provider who provides a tax-free account and doing it within. And then every rand, interest, dividends, capital growth compounds forever as long as it's in that account and it's untouched by SARS. What is important, this is money that you've already been taxed on. So say your salary is, 15,000, and after tax you're getting 12,000. It's that 12,000 that you're now investing. This isn't, for example, your Reg 28, which reduces your tax bill. This is your post-tax money. That is hugely important. And this really is something that is going to play out over decades. The impact on the returns, and we'll have some images of that in a moment, really is something that's going to be hugely powerful, but it needs to be given time for that power to fundamentally work. That's hugely important. So it was created in the budget of 2015. And Nene was our finance minister at that point. It is sometimes referred to as a tax-free savings account. Standard Bank uses and Shyft uses the tax-free investment account because, yes, you can use it as a savings account, but that's not its benefit. And for most individuals, that's not the best way to work with it. You're better off using it as an investment account. Now, if you are, I don't know, 95 years old or 75 years old or whatever that case may be, you might be saying, well, hang on, I actually just need some good old-fashioned savings account. This works as well. Absolutely, it does. As I said, you are investing after tax money, but everything it then makes and earns within that account is tax exempt. So no tax on interest, no tax on dividends, no capital gains tax in that account ever. And these numbers do stand up. It is designed to be held for decades. And I'm going to come back to it a couple of times. But in an ideal world, this would be the last money that you spend. And what I mean by that is at some point we hit retirement and we start drawing down on our investments that we have made over our working life for retirement. And as long as we don't need to, leaving the tax-free investment account to continue growing without tax implications, huge benefit, because you're Reg 28, you're paying tax on that into retirement. It is not a transactional account. Couple of points, and I'm going to come back to it in more detail, but I want to drive this home repeatedly. You can withdraw money whenever you want. You shouldn't. This is not an emergency fund. This is not a short term. This really is something that you want to keep and only spend in your 70s or 80s. That really is the plan. That said, you can transact in here as frequently as you want. You can have gone at the beginning of last year, for example, gone and bought the resources ETF, the Resi 10 ETF. That ETF then doubled in 2025. And at the end of the year, you were suitably smart and you sold that ETF, locking in the profit, paying no tax on that profit. And then you went and bought the emerging market ETF. And that's now having a spectacular run. You can buy and sell within the account as often as you want. That is not a problem. So in that sense, it is transactional, but it is not transactional in the sense that you should not be using it to dip into for short-term savings. All South Africans can have one. This includes children. There's no restriction on children having them at all. Of course, if they don't have FICA documentation, which in many cases they won't, their guardian, legal guardian will have to do the FICA for them, but certainly children can hold these accounts. There are pros and cons to children having a tax-free account. The pro, of course, is that you could start this on the day that they're born. And that means that when they do eventually start to access it in their 70s, they've got 70 years of tax-free growth that's compounded. And the numbers get absolutely staggering. The con, of course, is that when they turn 18, it's their money. And they could go, I mean, I remember being 18. I was not responsible about anything, I don't suspect. But you've got 18 years to teach them how to be responsible with their money. And so, T's and C's in that regard. Importantly, they don't need to have, as a child, a bank account or anything like that. At this point, they will need it when they draw the money out, but at this point, not so. So you can have one as an adult. You can have one you can open one for children as well. So it's open on the Shyft app or the website, and we'll have some screenshots, and it's managed there. It's nice and simple. You basically are buying any one of 130 plus active and passive ETFs, exchange traded funds. Now, I want to pause there a moment, and I know some of you know exactly what I mean when I say exchange traded fund, but I also know that some of you are scratching your head and thinking this man's throwing jargon. So let's delve into what is an ETF. ETFs started in December of 2020. So they're almost 26 years they've been on our market. They started globally in the early 90s. They've got a long track record. They are essentially, if you know what a unit trust is, right? A unit trust is just a collection of shares in a basket that you as an individual buy. An ETF is pretty much the same. Couple of key points. One, it trades on the JSE, Johannesburg Stock Exchange. So you would buy it through a broker account and through a broker or financial service provider, such as Shyft. And you would buy it in your tax-free account. We've got two styles of ETFs. We've got active and we've got passive. Active is like the unit trust. You've got a team of people with fancy degrees and spreadsheets and processes, and they are buying and selling shares with the intention of doing better than what the market does. In investing parlance, we call that creating alpha. They beat the market. The market goes up 12% over a period. They're going up 15%. And that extra 3% makes a fundamental difference to your earnings, compounded over time. A lot of them, at this point, probably about 70, so more than half of them, are going to be passive ETFs. In other words, this does not have a team of people trying to beat the market. This has a team of people who says, let's match the market. So if the market does 12%, your ETF will do 12%. And how do they do that? Well, they buy the shares in that market that I referred to. So say the market is, I mentioned a moment ago, the Resi 10, the resource stocks from last year. That is literally the 10 largest miners on the JSE put into one basket and just held. So it includes a lot of gold miners, it includes some platinum, diversified industrials such as Anglo-American and BHP, some Glencore, and it's just that basket of shares, and it replicates the market. You're going to say to yourself, well, okay, 12% is not bad, but that active basket, that's doing 15%. That's a whole lot better. Yes, but can the active basket consistently beat the market? That is the question. And what do they charge to try and beat the market? They will oftentimes charge 1.5%, maybe even 2%. So if they're only beating the market by 1.5% and they're charging you 2%, you're actually behind the curve. The passive ETF typically charging 0.1%, maybe 0.5%. In other words, a significantly lower number. And if you go to justoneLap.com/ETF database, disclaimer, I run that website, you will find all the ETFs there, and you've got different flavors. You could invest in tech, you could invest in India, you can invest in emerging markets, you can invest into South Africa, Japan, Europe, the US, and so the list goes on. So you can be fairly niche in what you want to be investing in, or you can be completely broad and say, you know what, just buy me a global ETF, or maybe I want an income or bonds or whatever the case may be. Importantly, we can start small. We don't need to be rich for this in any sense, and transaction fees are 0.15%. The value of the transaction plus VAT, minimum 20 Rand. So nice and cheap, nothing fancy, nice and simple. When you log on to Shyft, and I use the dark mode, so if you think this looks a little bit dark, it's because I use dark mode. When you log on to Shyft, this is the page that you're going to see. This is from the website. It is pretty much the same on the app, just obviously your aspect ratio is slightly different. You log on, and on the side, you will see invest. You click through to invest, and you will see tax-free investment account, as well as your traditional equity account, as well as your trader account. Importantly, you need to make sure that you are in your ZAR South African account. When I logged on the other day, I couldn't find it because I was in my US account. And that is an important point. You have to buy, or you can only buy South African listed ETFs. You can't buy individual shares. You can't say, I want to put ShopRite in my tax-free investment account. You can't. You've got to do those ETFs or unit trusts. You can't do individual shares. You can't do structured products. You can't do all of those type of fancy things. You can only do the collective investment schemes, ETFs, unit trusts, and the like. If you want to buy individual shares, that's fine. You open an investor account and you can buy your international, your ShopRite, your Standard Bank, etc. If you want to buy offshore shares, you can do that in Shyft as well. In your tax-free account, you're buying South African funds, collective investment scheme funds, we call them. That's the fancy parlance. Basically, it's investors who are all buying the same basket of shares, either passive, where it's tracking a market, or active, where it is focused on trying to beat that market. So you log on, you're already there, nice and simple. You've got the Shyft account, you click on it, you activate it, you're off to the races. Everything is great. No interest and no income tax, so zero tax in that regard. No dividend tax. If you receive a dividend from an investment on the JSE, you're going to get taxed 20%. Now, a dividend is profits, right? A company makes a profit, and the board of directors who run that company on behalf of investors, they get to say, well, what do we do with this profit? They can use it to maybe buy out competitors. They could upgrade equipment. They could move into new markets or make new products. But some of that profit, they sometimes, most often in the bigger companies, elect to give back to shareholders. That's you and I. And that is what we call a dividend. Sometimes paid twice a year, sometimes paid just once a year, and sometimes in smaller companies, they're not paying a dividend because they're busy growing the business. But investing in that ETF, they're holding those shares, they are receiving those dividends, and then they pay those dividends out to the individuals, that is you and I. And in a tax-free account, there is no 20% dividend tax. There's no tax on interest. If you earn any interest, it is taxed at your income below the threshold, 24,000 and change if you're under 65, 34,000 and change if you're over 65. That amount of interest earned by an individual taxpayer is exempt every year. Over and above, taxed as income tax, not if it's in a tax-free account. Capital gains tax, when you sell a share after holding it for 3 years, or an ETF or any investment, you're going to make a capital gain, a profit. The first 50,000 is exempt, and thereafter 40% is added to your income. So if you're in the top income bracket, effectively you could be paying 18% capital gains tax. Again, no capital gains tax. So more tax being saved. And this is for as long as you are invested and keep that money in your tax-free investment account. There is no interest. There are limits. I mentioned a moment ago, limits on what you can buy. ETFs, active, passive. There are also limits on how much you can deposit. You've got two limits. You've got an annual limit of 46,000 per individual per year. And then you've got a lifetime limit of 500,000 over your investment lifetime. Let's stick with the 46,000 for now. That is from March to February, so it is for the tax year, not a calendar year. You can do 46,000. You could do a lump sum. You could do a monthly amount. You could do it quarterly. You could maybe you can only afford 20,000, and then you do 20. Maybe you do it ad hoc. You commission, whatever the case may be. You get some money, you stick it in. It doesn't have to be lump sum. It doesn't have to be regular. It can be both. It can be either. It can be neither. It's entirely dependent on what your circumstances are, how you get to that 46,000 a year. And if you can't, I mean, in an ideal world, you do the 46,000, all of it, of course. In an ideal world, you do it on the 1st of March. But in a real world, well, sometimes things get in the way. So we do what we can every year. Very important. If you only can afford this year to put in, say, 40,000, that 6,000 that you didn't deposit this year does not roll into next year's annual limit. So next year, the limit just resets at 46,000. Now, to be clear, the minister can change that at the budget, and he did. He increased it this year up to 46,000, so he can change it. But until he changes it at budget, it remains at 46,000. And then your lifetime limit is R500,000. So that's about 11 years of investing. And at that point, once you've got there, so we started 10, 11 years ago, as I said, in 2015, March was when the tax-free accounts arrived. If you've been investing since then, and back then the annual limit was only 30,000. If you've been maxing out, you're probably approaching about 340 odd thousand perhaps that you've contributed over the life of your tax-free account. In other words, you're starting to approach that 500,000 lifetime limit. If you're only starting now, today, it's going to take you longer. It's going to take you at least 11 years, perhaps materially longer than that. I get a lot of questions. We've seen the annual limit change. Will the lifetime limit change at any point? Look, at this point, it is moot because no one's got there yet. But I would also say, I'm not sure that it does, because I think that Treasury is going to say, you know what, 500,000 left to grow tax-free. That becomes quite chunky. And we'll look at those numbers to get a sense of it. Important. These are limits per person across all of your tax-free. So if you've got a tax-free account at a savings account at Standard Bank, and you've got a investment account at online share trading, and you've also got one at Shyft, and you've got 3. Dave, Melville Douglas, you've got 4. Stanlib, you've got 5. Liberty, you've got 6. You could have 6 tax-free accounts. You don't get a 46,000 Rand limit per account. You've got one limit for you, 46,000 across all 6. Ditto with your 500,000. So opening more accounts, perfectly legal, not a problem, but doesn't change the limit. The limit is for the individual person. And what does matter here is be careful, because I know with my provider, at the moment, mine sitting with online share trading, if I tried to exceed the limit, it would block it and say, yo, can't do that. But if I've put some money in an account over there and then I come back here, Standard Bank is unaware of that fact. Your provider's not aware what you've done elsewhere. Now you've got to manage those limits yourself. You do need to report them to SARS so they will know. So if you were to contribute maximum per month, it would be about, what, 3,833. If we assume a 10% growth per annum, which I don't think is particularly onerous, that gets you about 13.5 million after 40 years. That's about 4 million more than if you hadn't had the tax-free benefit. So there's it illustrated. After 10 years, your tax-free account is around 700,000, and it is ahead, but not by a heck of a lot. After 20 years, you're about 400,000 better off because of the tax-free status. After 30 years, you're at 1.4 million better off because of the tax-free status. And after year 40, you are now, trying to do the math, 4.2 million better off. Almost a 50% improvement on your investment just because of that tax-free investment. And you're only growing at 10%, including those dividends. So the assumptions are that the limit stays at 46,000 a year. The lifetime limit stays at 500,000. You deposit until you're maxed out, and then you grow at 10%. Our market probably averages closer to 12%. That's fine. We take 10 here. You are having significant benefit from that tax-free component. Initially, as I say, it doesn't look like a lot. But this is why I say, in an ideal world, this is the money you want to spend last. Because after 30 years, you've done quite nice. And you've made, what, 1.4 million saved on tax. But that almost triples between year 30 and year 40. And that is the power of it. That is why we want it for long term. Now, I know, and I get this question often, folks will say, look, I'm already in my 70s. I don't have 40 years like Shelza. Agreed. Well, maybe you do. I mean, never say never these days. But anyway, maybe you've only got 10 or 20 years left of investing time horizon left. That's fine. You are getting a benefit of no tax. SARS is giving you a lieu on paying taxes. Grab it. You might not have the 40 years for the full benefit, or that kid who's maybe got 60 or 70 or 80 years for the full benefit. Totally get that. But there still is a benefit. Make no mistake. So the rules that we must know. Unused annual limit is lost. If you only do 40,000, that extra 6,000 does not roll into next year. It is lost. Next year, you reset at a 46,000 on the 1st of March. Withdrawals can't be replaced. Money you take out still can against your annual lifetime limit. So let me put it this way. The limit's 500,000. Let's say you put 40,000 in, right? So your 500,000 limit is now dropped to 460,000 because you put 40,000 in. Okay, makes perfect sense. You take that 40,000 out. Your lifetime limit remains 460,000. You don't reset that lifetime limit. That is why it is so important that we use this for money we really don't plan to use for decades. You can withdraw, but it really needs to be a proper emergency, not a flat tire or a holiday or something like that. If you over-contribute, if you put more than your 46,000 a year or more than your 500,000 lifetime, SARS charges 40% on the excess. So if you put in 50,000, that 4,000 extra, SARS will charge you a 40% penalty. Important, as I said, limits are combined across all the tax-free accounts that you hold. A child's account uses the child's limits, lifetime and annual, not yours. That's very important. You can transfer between providers. So if you're with a provider and you don't like them, the fees are expensive, the range is boring, whatever the case may be, you can transfer. But what you don't want to do is draw the money and withdraw it and go and deposit. You need to go open the account that you are transferring to. You need to contact the new account and the existing and say, I wish to initiate a transfer between these two accounts. You might need to convert the first account into cash, depending if you're coming from unit trusts to a broker. Broker can't hold the unit trusts. They're going to need to convert it to cash. And then the transfer will happen in the background. Because if you draw the money out, it loses its tax-free status. And SARS is not going to be interested. It needs to be transferred in the background. And as I said, you can transact as much as you want within the account. You can trade up a store. I know people who are doing, in some cases, they're doing 50, 60 trades a year. That's what, about one a week. The risk is that you're doing 50, 60 trades a year, one a week, and you're losing money rather than making money. But you certainly can transact. That is not a problem. Your limit is on the deposit into the account. And of course, what happens is you deposit the 46,000 and it grows to 50,000. That's fine. You haven't breached the limit. The limit was on the deposit only. And then it grows within the account. So the mistakes we want to avoid, treating it as an emergency fund. Withdrawals permanently waste that potential because they reduce the annual limit. I have seen advertisements around save for your wedding in 5 years. This is a terrible product for that. You're not going to get much tax-free benefit over a 5-year period, and you're not going to get the benefit of multiple decades. Using cash when you have plenty, 20 plus years of potential. I know the market can seem a little bit volatile. It can seem a little bit scary. It's been a wild year in stock markets. But if you're looking at decades, you don't need to be holding cash. You should have an emergency fund, sure, but it sits separate from your tax-free account. Circumstances change. When you're in retirement, you might want a cash buffer. This certainly can be useful because of tax, again. But as a rule, you've got time on your side. You don't want some cash. Careful of spreading across multiple providers, I said already, because you might breach the limits by accident. As I said, my provider, OST, if I try to put more than 46,000 in, it's going to stop me. It's going to say, you can't do that. You've already hit your limit for the potential. And careful of sort of stopping in a weak market. Consistency and being regular and leaving it even when markets are boring or when markets are falling or when markets are underwater. Just let it run. Don't worry about it. In the short term, markets are crazy. In the long term, markets will make us money. So where does a tax-free investment account fit? So first is an emergency fund in accessible cash. So this would be about 6 months expenses. Some people will do 3, some people will do longer. It's up to the individual, but about some cash that is sitting in an easily accessible savings account. And then some of it could be maybe in a 30 or 90-day account. The other week, my wife's car got a puncture. So you think, a puncture, that's $50. Except you go to the Tiger Wheel and Tire and you say to the person, I need a puncture. And of course, what does a tire person say? They say, well, no, we could fix it, but you need to replace these tires because 6 big reasons. And who are we to argue? We don't know anything about tires. So you walk out of there with a much larger bill. Thank you, emergency fund. Then your retirement annuity, which is probably, if you are in formal employment, you will have a retirement product, a Reg 28 of some sorts. That is upfront tax deduction, 27.5% or 430,000, whichever is smaller of your taxable, and then max out your tax-free investment account. And then you've also got your discretionary, so you'll have your other investments that you're managing on your own. Maybe they're shares, maybe they're ETFs, ETNs. There might be some structured products that have come out and the like, but with your sort of your more growth assets. And importantly, as I said, think in decades. The longer we're holding, the more tax we save, the more time we've got for growth, the better our portfolio does. So download the Shyft app if you haven't already. Open your registered log on for Shyft. Open your tax-free account. You can fund it from $250. You can choose your ETFs. You can automate a monthly contribution. You can do it ad hoc. You can do it however it works for you. And then, as I say, leave it to compound and resist that urge to withdraw. I know we're keen to withdraw, but don't do it if we can. So it switches off tax on your investments as long as that money is in there. When you pass away, if you still have money in the tax-free account, it will form part of your estate. And the money, the shares, whatever, they can't transfer. They will be sold, but there'll be no tax on those assets. 46,000 a year, 500,000 in total. The year runs tax year, so it's March to February. Withdrawals are permanent. I know I said it a lot, but avoid them. Look at growth assets, think in decades, and open it at Shyft. As I said, in 2 weeks' time, we're going to do Millionaire Tax-Free Portfolio, same place, same time. And then a week and a day after that, we've got a power hour with Standard Bank, either live in person or webcast on building an ETF portfolio. You start with one. How do you build up? How do you do the satellite process, core and satellite, all of that sort? We'll be doing that. As I said, will be 12th of August, justonelap.com/events for more information. Folks, that is me. But if there are questions, we certainly have time. If I can find a question, where is my question box? There it is. Perfect. And there is the chat. Rudy, yes. Would recording presentation be shared? Yes, we will be sharing. EJ, would OST be charging a custody fee on the tax-free? No, there's just the 0.15. I see there is a previous comment. Oh, there we go. That was just Palesa saying that they will be sharing it in that regard. Is it better to hold in Shyft or OST? MK, that's a great question. So Shyft, or OST rather, is migrating across to Shyft. So your OST account, and if you haven't had the comms, you will get it in the next couple of days, maybe a week or so. We are going to be migrating from online share trading to Shyft. So we'll all be moving across. We will be having some events on that as well. Both webcasts and in person up here in Johannesburg. We will have time for that. Let me see. Yep, David, so existing TFIAs will be moving across, and you don't have to do anything. You're going to get an email telling you what the process and when, and it'll just all happen in the background. Importantly, it will be transferred as a tax-free account, so you won't lose that tax-free benefit that we have. HW Fern, which tool can we use to optimize growth given a known universe and long-term focus? So we're going to deal with that in the next one in 2 weeks' time. I'm going to say broadly that what we're looking for is growth assets, which is a fancy way of saying we want equity. Bonds are nice, cash has a place, but for the long term, we really want those shares. We want those growth assets. The question then is, which growth assets? And as I said, we've got the range is absolutely huge in terms of, we can get individual countries across Europe. We can, we've got, well, not across, we've got Europe, we've got the UK, we can do India, we can do Japan, we can get access to China, we can get emerging markets. But there's some weird things happening. For example, I hold an emerging market ETF, and it's now all just tech. It's SK Hynix, it's Samsung, it's Tencent. The emerging markets have just been sort of overtaken by tech. But we'll go into that in 2 weeks' time. We'll also spend a fair bit of time on that when we dig into the webcast, the Power Hour on the 12th of August at the same time. Folks, I'm not seeing any more questions coming through. Are all offshore investments off the table? Fikri Davids? No, just within the tax-free account. So within a tax-free account, you can get offshore. You can go and buy an ETF that tracks the Nasdaq or the S&P 500 or the Euro Stocks 50. So you can get offshore, but it's done in rands. That's the important point. So it is done in rands. It's not been done in terms of in dollars or euros or something like that. So it's going to be done in rands. That is the important point. Within Shyft, you can then go and open the offshore part of the portfolio, and then you can go and buy individual shares or New York, London, Frankfurt listed ETFs. You've got the range. In the tax-free, they've got to be JSE traded. And we will talk a lot more around that in 2 weeks' time when we talk around the millionaire portfolio. Zalon, correct. Not all ETFs are qualified for tax-free. You are correct. So there are, for example, ETNs, which are exchange-traded notes, and there's legal distinctions, but they're not included. You can't buy the gold ETF, which just holds gold. Only asset is gold. You can't include that in either. You can't include AMCs, and those are actively managed certificates. So there are some exclusions. If you go to the tool, I pointed out the database on justonelap.com. We highlight which are able to be included in tax-free and which are not eligible for tax-free. So that's an important point, and we do specify that. Truthfully, There is a lot. There is in excess of 130 which are available for tax-free. So there is a lot that we can do in that regard. And then, folks, I am not seeing any more questions. No, I'm not. As I said, is the fee structure for tax-free on Shyft the same as that on OST? That's a great question. I'm not sure. I'm just not sure. And because I can't remember what OST charges. I think OST charges 0.15. So the answer is yes, because they're charging 0.15 with a minimum of 20 on Shyft. So fee structure remains the same. MK, why does OST not offer some that are supposed to be, e.g. the Oyster that was launched a month or so ago? MK, good question. No idea. The Oyster should be there. That's the one from TFIA. It qualifies as tax-free. It certainly does. I know that I chatted with Narina at the time, and she confirmed to me on my morning show that it is a tax-free. I will poke the OST folks and get them to add it. There's no reason why it shouldn't be there at all. It is tax-free compliant. Of that, I am confident. Narina Fisser and Gareth wouldn't make one that wasn't. David, you're asking when will existing TFIAs move to Shyft? As I understand, August is D-date. That's going to be happening in the next couple of weeks. As I said, there will be comms coming through, and as those comms arrive, we'll get more information exactly in terms of detail. Millionaire portfolio, where is it happening? Oh, that's a good point. Where? I didn't tell you. So I told you when. It's in 2 weeks, 4th of August, 11 a.m., exactly where we are right now. It is going to be happening on the Teams. If you've got invited to this event, you will definitely be invited to the next event, and you can certainly register for that. You want the Power Hour, thisonelab.com/events, and you can get information for that. Folks, I will leave it there. I am not seeing any more cues come through. You can always, as I said, you can contact the support desk at securities@standardbank.co.za. You're welcome to contact me. My contact details at simonbrown.co.za. I'm on all the social medias, emails, etc. All of that is available. You can give me a shout there. But until 2 weeks' time, ladies and gents, have a great time further. And everyone, as always, look after yourself. And if you can, look after somebody else as well. Cheers all.
Bye. Thank you so much.
But not always a pleasure. We'll chat in 2 weeks.